Want to thank all of you guys for tuning in, and thanks for joining us for the Multifamily Monday update. I think that Vince is or Travis is gonna start with a brief introduction, and then we're gonna dig into it. We're gonna try to get you guys out of here in the next by 12:30. Just a brief update.
Perfect. Yeah. Great afternoon, everybody, on this great Monday. I'm Travis Montgomery, the Marketing Director for the Multifamily Investment Advisors team here at KW Commercial and KW ONEChicago, where we've secured over $404 billion in sales volume for 2020 alone. And we also have that strong backing of a global real estate powerhouse, which is Keller Williams. So it's no surprise that we're the #1 real estate firm in the U.S. Our team specializes strictly in multifamily assets through the sourcing of exclusive opportunities for our clients. And by taking a novel approach with each of our clients' strategical needs, we're able to deliver them to the best outcome possible. So I'll actually let Tony Hardy, who's our executive director here at the Multifamily Investment Advisors team, go into a brief update regarding the entire real estate market. Oh, Tony, I think you might be muted there.
There we go. Okay.
Perfect.
All right. Yeah, I want to talk a little bit about some of the things that we're seeing in the marketplace. Can you see what has happened on your screen?
Yes.
Okay, awesome. So there's a number of things that are affecting the real estate market nationally, and some of those national implications are having an effect on the Chicago market. And Chicago is kind of a microcosm of the macro. One of the big things has been the COVID-19, the U.S. economy, the housing market in general, new construction starts, the commercial space, and luxury housing. And I think it's important, even though we specialize in multifamily, it's important for us to look at the whole dynamic to really understand the implications and some of the, I would call, unintended consequences of what's been happening. So we kind of peaked around January 1st, January 2nd, as far as COVID cases throughout the U.S. And then there's been a sharp decline these numbers are through February 11th. And the death toll is pretty close to $500,000 if they haven't, pretty close to benchmarking that. And it's had an adverse effect on our real estate industry. Initially, it was the initial shock of COVID, the rapid job loss. We lost more jobs in 6 weeks than we lost in any period prior to that. It took us years to lose that many jobs over prior periods, and it typically takes us a while to kind of claw back out of that. So a lot of the institutional investors and some of the larger banks and life companies immediately hit the pause button a year ago around this time, and they were looking at about just to kind of slow down and see what's going to happen, what's to come. And so what happened is some of the banks said, hey, we're not going to lend anymore. Some banks that were looking for market share jumped in and said, we're going to occupy that space. Some of the other lenders or institutional investors said, we're going to hit a pause button for 120 days. We're going to use our force majeure. We're going to wait till the dust settle before we jump back in the market. What we found is there were other investors that had been getting beat out by some of these large institutional players, looked at that as an opportunity to jump in, right? So there was kind of a musical chairs, if you will, as far as the investments, lenders, and some of the players as far as who were making some of the big investments. But when we look at it on the grand scale of things, the grand scheme of things, currently there's pandemics that happen pretty rarely. What we're thinking is COVID is going to be more of an endemic, whereas it's going to be something that we're going to eventually learn to live with, kind of like the flu. You'll go in, you get a flu vaccine, you'll get a COVID vaccine along with your flu shot once a year, and we'll get back to our normal state. Whether that happens, you know, in October or September, or whether that happens next October at some point, we do believe that this is here to stay. But if you look at the 1918 and 1920 flu, we lost 50 million people worldwide. In the U.S., I believe the number total was around 680,000, which we're on pace to outpace that number sometime in March, April. But I think that one of the things we didn't look at was the technology is a little bit better. Back then, they didn't have a lot of the things they have right now. I don't even think they had antibiotics. I don't think that they had definitely vaccines and things like that. So we're in a different space when we're comparing what happened then and what happened now. And we've gotten to a point where we can deal with that kind of stuff a little bit better. But the goal is to get the vaccines out to kind of mitigate and minimize the disruption through society, updated vaccines, widespread vaccinations, and better treatment regimens. Now, if we look at what happened to the unemployment rate at that time, we kind of jumped, right? Our average unemployment, or full employment that they call, is right around 4%. I think that the number when you're tracking employment is 6. And the reason we say that the number is 6 is because if you look at how the economists look at it, if unemployment is above 6, then there's a huge cause for alarm. If that number is below 6, then we're trending. Typically, they feel like we're trending in the right direction. So even though we like 5s, we like 4.6 is where we were in 2.6, 2006, 2007, right before the crash. That full employment number being 4, right, over the last, since 1950, since we've been tracking this number. If we can get it back down below 6, I think we've hit full, we're trending in the right direction. Right now, 2020, we ended the year off at 8.1 and things like that. So that's putting employment and unemployment in perspective from a more of a historical standpoint. And if you look at the monthly implications over that same period, right when March hit, we went from 3.5% to 14.7% in a very short time. But also the rollout of the stimulus was able to counterbalance that. We got those dollars out into the hands of Americans, and those dollars out within 6 to 8 weeks, which is something that rapid pace was able to minimize some of the effects and bring those numbers back down. And now you see, as of December, we're trending in the right direction. So that's where we are. We look at the sectors that were affected by the unemployment and the weakening earnings as of December 2020. Some of the sectors that were really hit hard, of course, is leisure and hospitality, right? So they got kind of walloped there. Financial services and professional services, and when you look at income by the hospitality got hit by like 21% right off. August 2020, 21%. They were able to pull it back a little bit, but that's one of the sectors that got hit really hard. GDP took a bit of a nosedive immediately Q2 2020, but we were kind of able to right the ship a little bit, if you will, when things started to open back up in Q3. And as soon as things started to open back up, we were able to turn that around pretty substantially. And we're hoping for the same things as they're doing the ebbs and flows. So the initial shock period is over, and we're starting to see things trend back in the right direction. But we still have a long way to go when you're looking at real GDP with a year-over-year percentage change. We're a long way from where we were just 12 months ago. So one of the things we want to talk about is home sales, right? Home sales have been trending in the right direction. And I think that the home sales is a good barometer for us to look at as multifamily investors as well, because I think that one of the things that we found is that space, that backyard space, is we are sheltering in place, and people looking to say, hey, I need to add an office or I need more space. That space became more sacred, and you're hearing a lot of realtors all over the country, all over Chicago, saying, hey, there's no inventory. Hey, the prices are really getting bid up here. And that's because, and we'll dive into that a little bit more later, but I wanted to put a plug in it right here at the home sale section, and open it back up in case there's some questions in the chat, and also to kind of pass the ball around to some other members on the team. So Travis, back to you.
Thanks, Tony, for that great information. We're going to take a brief pause here. I'm noticing that we're getting some great questions coming in from our live audience members. They ask, can you share some insight into the new ADU pilot zone program in the city of Chicago? I think that'll be a great question for our lead listing broker, who's Cody Danielcheck, to answer. I'll pass the mic over to you, Cody.
Yeah, absolutely. So I assume everybody has heard about the new ADU ordinance that the ULI ADU task force had helped develop for Chicago. It's pretty great news. The city's making strides towards moving towards legalizing our accessory dwelling units, or ADUs, and group houses, garden units, conforming and non-conforming units, right? Which is actually quite fantastic. And I'm just want to go over some bullet points of what this means for property owners. And we'll talk about what is being legalized, and that would be coach houses and conversion units, which are the other types of dwelling units. There are some restrictions which are pretty easy to kind of deduce, but in regards to how many ADUs can be built on a property, you take the amount of units that you already have, and as long as it falls within the ADU pilot zone, you multiply it by 0.33, and then you can round up to find out how many ADU units you can add. There's some limits as you start to move up in properties, but I don't want to get too granular right now. There are going to be some restrictions as far as the height of these ADUs based off the area. For example, Humboldt Park, you can't build higher than 24 feet or 22 feet, right in there. And all units need to be essentially made legal. The 2 points of egress and those types of restrictions are still going to need to be met, but we're moving in the right direction. It's a great way for us to force appreciation to our assets. And I actually have, am I able to share my screen?
Let's see.
Forgive me, I should have asked about that earlier, but.
There you go, you're ready.
Very cool. I would be happy to drop down this link in the description, but there's a website, Chicago Cityscapes, that outlines the ADU pilot zones very clearly. Can everybody see that all right?
Perfect.
Yes.
Very cool. I've been using this for basically just plug and play for any of our assets to see if they fall within the boundaries, and it kind of gives us a leg up to see, what fits where, and if we're already eligible for the ADU program. Now, one thing that I'd like to discuss as well is if you don't fall within any of these 5 pilot areas, you do have the option to apply for a variance, and then it's up to the city whether to approve or disapprove. And we can get granular about that later. So a majority of Chicago is still able to take advantage of this program and at least apply, which is fantastic. Does anybody have any specific questions about the program as it stands right now?
Not seeing any questions coming in the chat, but please feel free if you do have any questions, reach out to a member of the team or actually put in your question in the chat box right there. We'll be gladly able to answer it. I am seeing, however, another question that's coming in, another great question. Once again, I do encourage all audience members, if you have any questions, throw them in the chat or feel free to DM them in the chat to any member of the team as well. So I see that this question that's coming in has to do with the population laws in the city of Chicago. And the question is, are investors deciding to invest in places outside of Chicago because of crime, rising property taxes, and unbalanced legislation? I think this will be a great question for Vince, who's our lead buyer director at Multifamily Investment Advisors, to answer.
I appreciate you tossing me the ball on that, Travis. That's a very interesting question that I get a lot of times from clients and other real estate professionals that I converse with. We are indeed seeing a decline in population in Chicago. And many investors are, unfortunately, not many, but some are deciding to take their acquisitions elsewhere in some cases. And that's due to, population decline, the perception of, and in some cases, unfortunately, actual confirmed corruption politically, an outlook on tax assessments that may, have them thinking that taxes may increase. But, we also see reasons for optimism with, as Tony referenced, all-time highs in many cases that we're seeing in the residential market, that trickling over as a barometer for the multifamily market as well. We're seeing concrete developers coming into the city and kind of filling in that vacuum where many are deciding to leave. We've seen, with the federal review of the Obama Library in South Shore ending in December 2020, the groundbreaking has just been reannounced to occur this summer. We see Evergreen Real Estate Group has just invested in a $25 million development in the near north area that will be mixed income housing. We see Related Midwest has announced a mega development along the Chicago River between South Loop and Chinatown that will consist of 10,000 homes, as well as the Discovery Partners Institute partnered with U of I, committing to put a research facility on that land as well. So we see significant upside in the outlook coming to the market in Chicago, and many investors from out of town are indeed looking to fill the vacuum that we're seeing being created by some leaving. So very opportunistic situation being created. And I think a lot of investors, especially some that I've been talking to, are looking to take advantage of that.
Great information, Vince. See, we have another question coming in directed towards Tony. They said you told us a little bit of the national market, but can you bring it home and give us any insight on the local Chicago multifamily market?
Great question, and it kind of picks up where I left off, Travis. So I'm going to do a quick screen share again and talk about some of the things that we're seeing and how I think some of the national implications are affecting our local market. One of the things is at the beginning of this, everyone is like, "Hey, it's going to be a bubble. It's going to be a steep downcline," and some investors start saying, "Hey, I'm just going to wait until the foreclosures hit the market and then start buying up like gangbusters." Well, what has happened is the government stepped in and also banks stepped up, and there's no foreclosures, right? The courts are closed, right? So at some point, maybe foreclosures start happening, but it's pretty easy to get a forbearance right now. And the banks are working things out with multifamily owners. They're also working things out with homeowners, right? So this is the lowest period since 2008 in a very long time where the actual distressed sales in the market is less than 1%. Can you guys see my screen?
Yeah.
Cool. So distressed sales are less than 1%. So what we're finding is that those guys that were doing the fix and flip and those guys that I don't want to call bottom feeders, but the guys that are looking for the steep value discounts and the value add properties, if you will, they're having to come up with other options to figure it out. So what we're finding is that's making the Midwest more attractive. That's making Chicago more attractive to outside investors. And so there is, like Vince said, investors leaving the city because of unbalanced legislation, increased property taxes, and all of these crime and some of these headwinds that are coming in. But we're also seeing other investors from the East Coast, the West Coast, and some of our offices even out of the country, where we're having investors coming in trying to get into this market, get into the Midwest, and get into Chicago because there is opportunity here, right? We were never a 4-cap market like Miami or parts of California. So they're still able to come here and get a decent return, and that's looking a little bit more attractive, right? Also, there's 77 neighborhoods in the city of Chicago. And with these 77 neighborhoods, you can kind of pick your poison, right? You can go downtown if you want a little bit less risk, or Lakeview or Lincoln Park, or you can go to the South Loop or West Loop if you're looking for a different mix. But I think that the distressed sales is something that's different, that creates an opportunity where if you're thinking outside of the box. I know that Mo on our team recently listed a portfolio of 100 single families through 4-unit properties, 1 to 4 unit properties. Those properties are available. They are rental properties, right? But a fix and flipper that's used to flipping 20 or 30 properties in a year, or 5 or 10 properties a year, can come in and buy those properties at a little bit of a discount. You ain't gonna get it for the same price you would get a vacant bungalow for, so to speak, at 60 grand, but maybe you get an occupied bungalow that has the infrastructure improvements at 90 or 100 grand. And then as those units turn over, you got something where you could clean it up and fix it and sell it to the first time home buyer. That's thinking outside the box. You can reach out to them for more information. Affordability, 2020. One of the things that's also keeping our market strong is the drop in the decline in interest rates, right? So when the interest rates went down, the home prices went up. And we also saw another counterbalance to what's going on is we saw a sharp increase in appreciation. Last year, appreciation was 9%, right? Typically, nationwide, we're looking at 4-5% appreciation is good. So we almost saw it in some markets. We saw appreciation at 11 and 12% last year. I know that part of that is that homeowners and lenders can afford a little bit more house, a little bit more bang for their buck, right? So we're looking at the long-term median price of homes. That prices went up, right? It went up substantially, right? We're at if you're looking at this over even since 1989, we're peaking, even though the market is moderating a little bit. And we're starting to see listing agents surprised that they're getting values substantially over asking price. Again, we're looking at the interest rate in relation to median home prices. And even though we've been hearing this for a long time, interest rates are at an all-time low, 2.6%. 2.6% is very low. But I don't want to steal all of the thunder here. Also, we're seeing inventory. That's where we're seeing the market is there's no inventory. They're right. They're correct in that. We're looking at 3 months of supply, 3 months of supply, annual supply. When that number balanced or typical supply in the market is 6 months worth of inventory. There's enough inventory in the MLS, so to speak, or in CoStar and LoopNet, available exclusively listed inventory to satisfy a 6 month supply. And that's where it's kind of a seller's market. It's kind of like a balanced market, right? Now with less inventory, we got 3 months supply. We're having a lot of fight it out for some of the choice assets and some of the choice location. Back to unemployment. If we break down and bifurcate the unemployment and we look at who's employed, who's not employed, and who's buying homes and who's buying real estate, as opposed to, and a lot of this is counterbalanced, right? So the same guy, 24 years or younger, those guys are buying about 3% of the multifamily properties. They're buying about 3% of the single family homes. Their unemployment rate is 9.7% right now. is really not having that big of an effect on sales because those weren't the guys that was buying all the property anyway, right? Same thing, the 24 to 34 age group, they typically are investing, and 23% of the time they're buying, but the lion's share of the investors, the lion's share of the homeowners, the buyers are age 35 plus. And if you see, their unemployment rate is still kind of normalized, right? It's still right where we're saying close to full employment. So when we reverse engineer it, now we're seeing why there's been a shift, but again and again there hasn't. Now, I'm not saying that some of these guys that are at the 74% mark aren't working at a job that they weren't working at 2 years ago. They may have taken a little bit of a salary hit. We got some news over the weekend that CBRE, the second largest real estate company in the U.S., behind Keller Williams, they laid off 200 people over the weekend, right, in their Texas offices. So there is a shift happening in our space, but I think that there's enough there for us to kind of dig in and see that there's also opportunities. Back to you, Travis.
Couldn't agree more with you there, Tony. I also want to let Drew, who's our director of market analytics, speak a little bit more about the capital markets.
Thanks, Travis. I'll be brief here, but today we're seeing the 10-year Treasury at 1.35, and it's been on a very strong uptrend year to date. It's up 42 basis points, and just this month alone, it's up 27 basis points. We're seeing some lenders ask for larger reserve requirements, and we're hearing some lenders being more conservative. But with that said, our team personally has not experienced a huge increase in interest rates, as we recently put a deal under contract and the buyer was able to lock in a 2.7 interest rate. So that's something to look out for with the rising Treasury. But like I said, we haven't seen a huge jump in interest rates in regards to the deals that we're working.
Definitely appreciate that, Drew. Well, I don't want to take up too much of you all's time here. I see that we're at the 12:30 limit here. Just wanted to give you a few updates regarding some upcoming events that we'll be having. Of course, the Real Producer Chicago is having an event this upcoming Thursday at 9 a.m. And then also we have the Southside Community Investors meeting at Thursday at 5:30 p.m. And of course, as always, if it's Monday at noon, the Multifamily Investment Advisors team is going to be here giving you some market updates, here to answer questions and assist you.
Thank you.
Thanks, guys.
Excuse me, Travis. Excuse me. Can I add a comment right quick to everyone?
You're in here. Yeah, go for it.
Yeah, I did raise my hand. Okay, so I just wanted to make a suggestion that Commissioner Maurice Cox on February 11th with the Chicago Emerging Minority Developer Initiative made the announcement that the city of Chicago will be facilitating funding for multi-unit properties, mixed-use properties, by dedicating $10 million to the Neighborhood Opportunity Fund larger round to help facilitate investors communities. They're willing to contribute not only NOF dollars this year, but also tax increment financing. I left my information in the chat box with anyone who has any questions regarding that. Thank you.
All right, we'll definitely follow up with you online on that. There may be an opportunity for you to let the investors know at the Southside Community Investors meeting later this week. Thank you for that. All right, guys, make it a great week, and talk to you soon.
Thanks, guys.